And we're live. Welcome to the live stream. I'm Tomo. I'm really excited to be here tonight because my portfolio has just hit a valuation of $50,000. And I started with big fat donut, nothing whatsoever. So in the live stream tonight, I'm going to share with you what I did to get to that $50,000, the process that I adopted when I was investing, what I invested in, and the tips and tricks and traps that I learned along the way. And hopefully that'll operate as a little bit of motivation for you on your investing journey. And hopefully that'll get you going in the right direction. Quick disclaimer, I'm not a licensed financial advisor. Anything I discuss tonight is purely for educational purposes only. Me simply sharing my experiences with you. Nothing should be taken to be a buy recommendation. So welcome to the live stream. Now, why is my valuation important? And I'll tell you why. And it's because of this graph right here. Shout out to Equity Mates, great podcast. And all you need to concern yourself with is the first tile in this graph. So my valuation is $50,000. I am halfway to a $100,000 valuation. And on a bigger journey to $1 million. And you'll see the $100,000 tile is the absolute hardest to beat. It's the hardest to reach. It takes such a long time. But you'll see once you reach that tile and you start to move up the columns, it moves exponentially. The power of compounding is absolutely massive in those later years. So I'm really happy because I am halfway on that first tile to my first $100,000 investment. How did I get to my first $50,000? What did I invest in? What was my process? I'm going to share another Excel with you here. Okay, so this is the amount I've invested through different stages of my life to reach that $50,000 valuation. Now I've highlighted a few numbers that I want to talk through, and these are the yellow. So you'll see I started in 2016 at the age of 28. And you'll see in these first years between 2016 and 2019, the amounts I invested were very, very small sums of money. They weren't very much at all. And I also started late when I started investing at 28. So for me, I kind of had two careers. My first career, and then I decided to have a completely different career change, went to university, reskilled myself, and started my second career. So I was kind of always behind people in life, if you want to look at it that way. So I started investing at the age of 28, and you will see that during this time, I was only investing really, really small sums of money, $17 per week, $14 per week, that sort of thing. And so a key learning or a key message that I would give to people here, if you can start younger, if you can start at the age of 20, and if you can get that number up to $50 per week, you can really, really set yourself up financially, set yourself up for success, and put yourself in a real strong financial position. I was only investing in really small sums of money because I was going into my first entry-level job. So it was really, really tough for me to invest larger sums of money at that. If you can get to $50 a week, now don't invest your food money, don't invest your rent money, don't invest money that's going to leave you poor, broke, struggling. Invest what you can. But if you can get to $50 per week, that'll really, really set yourself up for a strong financial position. And then you'll see, as I got my first, I'll call it my first real promotion or my first well-paying job, that's when my numbers started to increase around 2020. And you'll see the numbers increase much, much here in these later years once I started to have a little bit more disposable income to spend on investing. You'll see I'm up to around, some years around $90 per week, $56 per week, some of those much stronger numbers. So the key thing that I would advise here and recommend here is if you can start while you're young, that is a really, really good place to start. The magic of compounding by having more time in the market when you're young is your biggest weapon. Me, I started late. That's okay. I'm playing a bit of catch up. But if you can start when you're young and you can invest, try and get to about $50 per week. That's a really good number. You'll really set yourself up for financial success. Now, what you want to do is really set up good financial habits. What I did, good financial habits. So we know what good habits look like, and we know what bad habits look like. So going to the gym is a good habit to get into. But if you miss one day, then maybe you miss 2 days, then maybe you miss a week at the gym, then it makes it much easier to miss that second week at the gym. When you start going down that slope, you start to fall into bad habits. So one thing that I would definitely recommend to people, what I did, set yourself in really good financial habits at a young age. So when I got paid, I would automatically transfer a sum of money, what I could afford to invest, into my investment account every payday without fail. What you can afford, have an automatic transfer up to transfer it out of your main account into a separate bank account. Now, in terms of having good financial habits, investing at a young age, all those things have helped me get to this $50,000 valuation. How did I do it? What's the process? Should you wait for the market to dip? Should you wait for the market to crash? Or should you adopt a dollar cost averaging approach? And just to keep things a little bit interactive here, I'm going to show you a video so you just not listen to me speak the whole time, which will really explain the benefit of this.
You will buy periodically regardless if it is a bull or a bear market. On the other hand, the buy the dip strategy is when you only buy stocks when they are going down. As the stock's price dips, it may present an opportunity to pick up shares at a discount price. The problem here is that you have to know how far the stock is going down. You need to time the market to make this strategy work. Nick Maggiulli made a study comparing the dollar cost average and the buy the dip strategies. For dollar cost average, he considers an investor who invests $100 every month. And for buy the dip, an investor who saves $100 each month and only buys when the market is in a dip. For this scenario, he considers that the investor would know exactly when the market is at the absolute bottom between any two all-time highs. Logically, it seems like buy the dip can't lose. If you know when you're at the bottom, you can always buy at the cheapest price relative to the all-time highs in that period. However, if you actually run this strategy, you will see that buy the dip underperforms DCA over 70% of the time.
So that's really interesting. That was actually a good book called Just Keep Buying by Nick Maggiulli, I believe the name is. And so why does dollar cost averaging outperform buy the dip? And the reason for that is that market crashes, market corrections, don't occur that often, don't happen that often. Yes, the market goes down 10% sometimes, goes down 20%, but a massive market crash doesn't actually happen that often. So if you're continually waiting with your money on the sidelines for a market crash, that means it's not deployed and it's not in the market getting that good compounding machine working. So there are periods where buy the dip outperforms dollar cost averaging. And those generally occur around big market corrections. But generally speaking, they're about the same, or dollar cost averaging outperforms buy the dip by a little bit more. So that's the process that I adopted. Really getting into good financial habits in transferring an amount that you can afford every week and investing every week under a dollar cost averaging approach. That's really helped me to get to that $50,000 valuation, and I hope it should help me get to a $100,000 valuation as well. So the next thing that I wanted to discuss is, what did I invest in? So when you're investing, you normally have two options. The first option is investing in individual companies, and the second is investing in ETFs. So when investing in individual companies, my performance was so-so. I did really well and had some really great performance in investing in individual companies, and I also had some stinkers, and they've basically offset each other more or less. Now I'm positive in terms of the companies I've invested in when I've invested in individual stocks, but they more or less offset each other. Some of the companies I've invested in, again, which is no financial recommendation, that have done really well for me, were Berkshire Hathaway, Warren Buffett's company. During COVID, they were trading pretty much at their book value. So the way I looked at that is you could invest in Warren Buffett's company, which meant you held all the portfolio companies that he was holding, and you got Warren Buffett's mind for free. That's the way I looked at that. So that's been a really strong investment for me. Another strong investment for me has been Center Group, which is Westfields. Again, invested during COVID. I need to give credit to my brother for that one. So basically, Scentre Group stock dropped dramatically during COVID, and with the idea that we're not going to attend shopping centres anymore. There's no way we're going to attend shopping centres anymore because of the virus. And me and my brother discussed that and thought that was baloney. We're always going to go back to we're going to get out of COVID and always return to shopping centres. So we got that at a really cheap price as well. Some of my stinkers, I was invested in the casinos when that all the news articles and everything was coming out around them. So overall, I'm positive on my individual companies, but the overwhelming majority of my share portfolio, of my growth, has come in the form of ETFs, things that track the overall stock market performance. Those have been my main focus of what I've been investing in, and those have been my best performers as well. So why are ETFs been my best performers? And I want to show you, this is perhaps my favorite news article. It's a little bit old now. It's from 2023. However, this theme is very real. It's very, very consistent. And I want to read the highlighted section for you. So this article found that 88% of active large cap funds, so an active fund means professional investors, funds that go out there and look for companies, look for stocks to invest in as their job and charge fees for that. That's an active fund. So it found that 88% of active large cap funds failed to beat the S&P 500 over the last 15 years at the end of 2023. And if you look for a shorter time period, a 3-year period, about 80% failed to beat the benchmark. So what that means is professional investors that invest day in, day out as their professional job, fail to outperform the stock market as a whole. So that's really influenced my decision. I do my investing in my spare time. Maybe you do it in your spare time as well. And if these professional investors are unable to beat the overall stock market as a whole, then I just thought, why even bother trying? Why even trying? I'm quite happy with the market return, or I would only hold that thought. We'll come back to that in a minute. So I was like, okay, professional investors unable to beat the stock market as a whole. So I kept my main focus around ETFs. And am I happy, or should you be happy with the returns of ETFs? So let's take a look at this next graph. So this is a graph of the Australian share market returns over the last 124 years. Now, you might not be able to see the text, so I've kind of blown up that box to make that a little bit larger. So over the last 124 years, the Australian share market has returned an average of 13% per year. That's the average, 13% per year. All the green tiles are the positive years, all the red tiles are the negative years, and you can see all those tiles stacked up in the middle around the 10 to 20% mark. So investing in ETFs has really, really helped me reach that $50,000 mark. And my approach has now changed to predominantly focus on ETFs, which track that stock market return. And those could be ETFs that track the Australian stock market. They could be ETFs that track the United States stock market. Could be ETFs that track Europe and Asian stock markets. It could even be thematic ETFs that track particular industries. Those have been my main focal area, and I will now only invest in companies where that company will have a return of greater than 13% per year, because it has to be better than the overall stock market return. That's been my focus area, ETFs, and that's been a large contributor and a large help for me to get this $50,000 share valuation. Now, in terms of my approach, what I adopt now is what's called a core and satellite approach. So I still am not opposed to investing in individual companies. Some people call that a punt. I have a bit more of a process than just having a punt, but I still do like to invest in individual companies. So the process that I adopt is this process called a core and satellite approach. And what that basically means is around 60%, this is saying 65 to 85. You can kind of choose the percentages, but at least 60 to 65% of your core holding is in these ETFs that track the broader market. And that means your core return should closely align to those markets. So if it's just the Australian share market you're exposed to, over the long term, your core return should be around that 13% mark. And then for the satellites, those are the smaller positions. That's where you can invest in your individual companies. That's where you can invest if you want to hold a little bit of crypto, or if you want to invest in bonds, cash, other sorts of assets. To have a bit of if you want to have a bit of a speculative, so I was going to say speculative punt. It's not quite the right word. But if you have that itch that you want to scratch where you still want to invest in individual companies and other asset classes, that satellite approach is really, really good in allowing you to do that. And so that's been my approach that's got me to this $50,000. So I'll re-summarize. First of all, make sure you get yourself in good financial habits. If you can automatically transfer an amount from your pay every week, every pay, to an investment account to invest what you can afford, only what you can afford to afford, you'll put yourself in a really good financial position. Now, if you can start that while you're younger, in your 20s, and you can get to at least $50 per week, you'll really, really see you'll really set yourself up for a strong financial position. What I did then is what to invest in. I chose the path of investing in ETFs that track those broader market returns. We've seen even professional investors struggle to beat the market return as a whole. And the way that I've done that, or the way I'm kind of starting to move towards to do that, is this core and satellite approach. Now, if you want to see a bit more detail, things on like dividend investing, things on stocks versus ETFs, I've done a separate video to that, which I'll leave a link in the description. Thank you for stopping into the live stream tonight. I had a great time, and I wish you the best on your investment journey. I'm Tomo. Great to see ya.